Hey there, fellow investors. Welcome to another exciting journey into the world of finance. Today, let's dive deep into the fascinating topic of undervalued stocks. These stocks are often referred to as the hidden gems of the market. They're like diamonds in the rough, just waiting to be discovered and polished. An undervalued stock is simply a company whose true worth is higher than what the market currently reflects. This discrepancy can be due to various reasons. It's like finding a $100 bill for just $50. A steal. Imagine the potential for profit. Finding these undervalued stocks is the key to unlocking big profits and achieving financial success. That's what we're here to learn about today. We'll explore the strategies and techniques to identify these opportunities. We'll equip you with the tools and knowledge to spot these opportunities and make informed decisions. Get ready to become a Wall Street wizard. With the right approach, you can navigate the market like a pro. Remember, investing always involves risk. It's important to be cautious and well-informed. But with the right strategies, you can minimize that risk and make smart investments. You can maximize your chances of success. Let's dive in and uncover those hidden gems together. Why is it important to find undervalued stocks early? Imagine getting in on Amazon or Apple before they exploded in value. That's the power of early identification. When you spot an undervalued stock before the market catches on, you position yourself for massive gains. Think of it like buying a house below market value. As the neighborhood improves and demand rises, your investment appreciates significantly. The same principle applies to stocks. Early identification is key to unlocking exponential returns. Don't wait for the crowd to catch on. By then, the opportunity for significant profit might be gone. Be the early bird. Get the worm. Now, how do we find these undervalued stocks? It's a question that intrigues many investors. One powerful tool is fundamental analysis. This method allows us to dig deeper into the financial health of a company. It's like looking under the hood of a car before you buy it. You wouldn't purchase a vehicle without knowing its condition. You want to examine the engine, the mileage, everything. Every detail matters when making an informed decision. Similarly, fundamental analysis involves digging deep into a company's financials. We scrutinize balance sheets, income statements, and cash flow reports. We look at things like the price to earnings, PE ratio, which tells you how much investors are willing to pay for every dollar of earnings. This ratio can reveal a lot about market sentiment. A low PE ratio could indicate undervaluation, suggesting the stock might be a bargain. Then there's the price to book, PB ratio, comparing a company's market value to its book value. This metric helps us understand how the market values the company's assets. A low PB ratio might suggest the stock is trading below its intrinsic worth, offering a potential investment opportunity. Finally, we consider the dividend yield. This is a crucial factor for income-focused investors. This is the annual dividend payment divided by the stock price. A high dividend yield can be a sign of undervaluation, indicating a potentially rewarding investment. A high dividend yield can be a sign of undervaluation. It suggests the company is returning a significant portion of its profits to shareholders. By carefully examining these metrics, you can begin to separate the undervalued stocks from the overhyped ones. This thorough analysis can guide you towards more informed and potentially profitable investment decisions. Let's look at some real-world examples. Take Tata Motors, the Indian automotive giant. Despite facing industry headwinds, their aggressive push into electric vehicles and strong market presence in India make them a potential candidate for undervaluation. Another example is ITC Limited, a conglomerate with a diversified portfolio spanning cigarettes, FMCG, and hotels. Their strong brand recognition, robust financials, and consistent dividend payments present a compelling case for undervaluation. Remember, these are just examples. Thorough research is crucial before making any investment decisions. Past performance is not indicative of future results, but by understanding how to apply fundamental analysis, you can identify potentially undervalued stocks like these. Section 5. Technical analysis. Timing your entry for maximum gains. Fundamental analysis helps us identify potentially undervalued stocks, those hidden gems that might be overlooked by the market. But timing is everything in the stock market. Entering at the right moment can make a significant difference in your returns. That's where technical analysis comes in. It provides the tools to understand market movements and trends. It's like reading the waves before surfing. Just as surfers wait for the perfect wave, traders wait for the perfect market conditions. You want to catch the perfect wave at the right time. Timing your entry can lead to a smoother and more profitable ride. Technical analysis involves studying charts and indicators to predict future price movements. It's a way to read the market's mood. Moving averages, for example, can help identify trends and potential support or resistance levels. They smooth out price data to help you see the bigger picture. The Relative Strength Index, or RSI, measures the strength of price movements and can signal overbought or oversold conditions. It's like a market thermometer. Bollinger Bands, on the other hand, show volatility and potential price breakouts. They expand and contract with market volatility. By using these tools, you can time your entry and exit points more effectively, maximizing your profits and minimizing potential losses. It's all about making informed decisions. Section 6. Growth Potential. Riding the wave of innovation. Identifying undervalued stocks is not just about finding cheap companies. It's about identifying companies with strong growth potential. Look for companies that are innovating. They should be disrupting industries and capturing market share. Strong revenue growth is a good indicator of a company's potential. Look for companies that are consistently growing their top line. They should be expanding their customer base. Innovative products or services are another positive sign. Companies that are constantly developing new and exciting offerings are more likely to succeed in the long run. Remember, you're not just buying a stock, you're investing in a company's future. Section 7. Market Sentiment and News Analysis. The Unpredictable Forces. The stock market is like the ocean, vast, powerful, and sometimes unpredictable. Market sentiment, the overall mood of investors, can significantly impact stock prices. Positive news can send prices soaring, while negative news can trigger a sell-off. Staying informed about market trends and news is crucial. Pay attention to economic indicators, industry reports, and company-specific news. Be aware of geopolitical events and their potential impact on the market. Remember, knowledge is power. By staying informed, you can anticipate market movements and make more informed investment decisions. Section 8. Strategies for Success. Your action plan. Now, let's put it all together. To spot undervalued stocks, combine fundamental analysis, technical analysis, growth potential evaluation, and market awareness. Start by screening for stocks with low PE, PB, and high dividend yields. Then, use technical analysis to identify optimal entry and exit points. Look for companies with strong revenue growth, innovative products, and a solid management team. Finally, stay informed about market sentiment and news that could impact your investments. Remember, this is not a get-rich-quick scheme. It requires patience, discipline, and continuous learning. Section 9. The Call to Action. Don't miss out. Now you have the tools to become a master at spotting undervalued stocks. Don't let this knowledge go to waste. Start putting it into practice today. Begin by researching companies in industries you understand. Analyze their financials, study their charts, and track their news. Remember, the stock market is a marathon, not a sprint. Stay patient, stay disciplined, and never stop learning. The rewards for those who persevere can be substantial. Section 10. Bonus surprise. exclusive insights for our readers. As a special thank you for joining us on this journey, we're offering you exclusive access to our premium stock analysis tool. This tool will provide you with in-depth financial data, real-time market insights, and expert recommendations to help you make more informed investment decisions. Don't miss out on this incredible opportunity to take your investing to the next level. Click the link below to claim your free trial today. Happy investing!